Okay, good morning, everybody. And thank you so much for joining this technical class for beginners. We're just going to get started in the next 5 minutes, just sorting out a couple of technical things on this end. Um, but once that is sorted, give me another 1 or 2 minutes. Once that is sorted, then we should be good to go. But I think we are almost there. And I also want to give this opportunity to those who might be joining us a little bit late, because this is the last of this class, this particular stream, which we'll be holding. And then after that, we'll move into class two, which is when we start to talk about indicators, strategies, um, and then tips for trading different markets when you're trading on several platforms. But first of all, again, good morning and welcome to the technical analysis class for beginners, stream two. This class is sponsored by Eagle Global Markets, which is a global trading platform based in Nigeria, but provides access to global markets for forex, for commodities, for cryptocurrencies, and for trading various, other products as well. Now, we'll go into that in a lot more detail later, but just before we start, like I said, I just need a few more minutes and I will get us on the way. So I'm just going to briefly change the scene here, and you will notice a few things once that happens, but we'll be right back. Okay, we are back. Good morning, everybody, and thank you for joining this class on technical analysis. Um, Now, there's a link to the materials on the Twitter thread I posted, and if you don't have that, I'm just gonna put that on the chat also. Um, I see people mentioning that they don't have audio on their side. Please let me know if you have audio restored now. So, just a bit of a guide to how this will work. I will, if you have any questions, please post it in the chat window. Okay, so the link to the materials is now posted. You should be able to see it in the live chat window. Um, and Maximus Michaels, please let me know if you have audio on your end now. Okay, good morning, everybody. It's a pleasure to be always. I always count it a privilege to stand before people and teach, and I think this is also a privilege to come to you by this channel to provide you training on technical analysis. This is really for beginners, and this is something I'm hoping that will help you become a better investor in financial markets, and that's why we're doing this. And for those who may be joining us for the first time, again, let me just tell you this class is brought to you by Eagle Global Markets. Eagle Global Markets is a global trading platform that provides a trading platform based in Nigeria that provides a trading platform for professionals in Nigeria to also invest in various markets across a very wide spectrum. You can invest in currency markets, you can invest in commodities, you can invest in equities, you can invest in cryptocurrencies. This is what the trading platform looks like. When you are subscribed and when you have a live account, this is what your account looks like. It gives you ability to invest in different types of currencies, different types of cryptocurrencies. Pretty much most of the cryptocurrencies are listed here for those who want to buy cryptocurrencies. Um, if you want to buy equities or stocks in different markets, like let's imagine you want to buy all this Tesla and the likes. You can buy that here as well. You have shares. Let me see. This is UK shares, US shares rather. Yep. Tesla is a T, so US shares T. So for those who like to buy Tesla, you have your Tesla there, and you can simply pull up the chart here, and you can see the price is there. You can see what the chart looks like. You can see all that from just this your trading screen. So it's a company based in Ikoyi, and I've traded with them for several years. I've had this particular account since 2000 and 2011. I think 2011, 2012. So I mean, it's stuff I've seen and tested as well. And like pretty much any trading platform, of course, I need to tell you that you it's a they trade derivatives, they trade contracts for differences, which are high risk products. So you need to have a significant amount of knowledge before you actually trade on this kind of platforms. But when you do, you also have the opportunity of making significant returns. So they are the sponsors for this program, and there's going to be a link later on where you can set up an account if you want to trade. I'll also give you a link to set up a demo account so that you can test out your trading strategies or what you want to do before you actually go into the live market. Okay, so that said, let's get today on the road. Um, so I'll start with an introduction. For those who don't know me, who probably have only been seeing my Twitter threads or tweets and so on about investment markets, financial markets, and so on. My name is Dolapo Oni, and I have worked mostly as a research analyst, investment analyst across my career in Nigeria for about 14 years. And currently, I live in Canada, Calgary, Canada, where I work as an investment associate with a wealth management firm. So basically I started in asset management as a trader back in 2006, and I focused entirely on trading various financial markets. My core responsibility was trading currencies and commodities. So I was trading oil and I was trading gold, but I was also trading currencies like Euro USD, cable. That's the British pound against the USD, USD against Swiss francs and against Japanese yen. I traded in that asset management firm for a while before I joined a risk rating agency where I worked in research, started covering the oil and gas industry there, and then I moved to EcoBank, and I spent the better part of my career in EcoBank covering the global energy markets. Before I left Nigeria, came back into wealth management here in Canada, where I currently provide investment services for very wealthy Canadians, advising them on tax, trust, managing their estates, and basically helping them make their investments across various financial markets, helping them grow their funds, grow their wealth, and so on. So, this is basically a background to who I am and what I do, and this is still definitely my market. So that's why I want to provide a lot of these guides through my YouTube page. So if you haven't subscribed, this is an opportunity. I'd like to encourage you to subscribe to my YouTube page. There will be a lot of guide on developing your career, developing your skills as an investor in various markets. And over time, I still introduce a lot more content, especially about the energy sector and also about how to be a good research analyst or a good analyst, basically. So there will be a lot of content that you find quite useful. And I think subscribing will do you good. So subscribe and also turn on the notification so that you know every time there's a new video posted. So that's by way of background. But today, what are we going to be talking about? We're going to be talking about technical analysis. Let's get that up so that we can start with that. And that's what we're going to be talking about today, technical analysis. And if you need to get pen and paper, make sure you get it. If you need to get a cup of coffee, make sure you get that also. Let me put this in slideshow mode so that it's slightly bigger. I'm also going to try and get a cup of coffee so that we can start talking easily. Now, where did this start from, or how do we initiate this discussion around technical analysis? Why is technical analysis important in markets? Um, one of the things I like to tell people is the fact that technical analysis is actually the oldest form of analysis in financial markets. Many people don't seem to recognize that. The reason why is because when you understand technical analysis, you start to see why that is the case. So first of all, let's start with a definition of what technical analysis is. Okay, so what is technical analysis? I think there might be an issue. I don't think you're seeing my slide on your end, so let me quickly escape from this and let me use this screen because this is the screen that you guys can see. Okay, so what is technical analysis? Technical analysis is the use of pricing charts, historical pricing data, and market indicators to indicate market movements, identify trends, and generate trading signals. I mean, for entry and exit from an investment position, that's the key thing. So, really, technical analysis is you trying to use the pricing charts that you can see for a particular asset, the historical pricing data that is available for that asset, and then various market indicators that are provided by trading platforms to understand where the direction of the market for that asset, identify the trends that are present in that particular trade, in that particular price chart, that gives you a very clear signal of when to enter into that asset or when to exit from that asset. So then you understand why I said that is actually the oldest form of analysis there was. And the reason why it's pretty clear is because for a very long time, before companies started publishing data, releasing information or reports and all that, because that was all that was available. Price was all that was available. Now, so since price was the only thing that was available, then that's the only thing you can actually analyze. That's the only thing you can actually see. That's the only thing you can actually say, oh, I want to check how this company is doing or how this particular asset is doing. So the bulk of information or analysis that had to be done then was based on the price that was for the asset itself. When its price is high, then you know that there's high demand. When the price is low, then you know that there's low demand, or there is oversupply and so on. So a lot of analysis started from, first of all, from looking at the price of various asset classes, understanding what was going on in those asset classes, to then start, before we actually started being able to then analyze companies using what we call fundamental analysis. So, as someone who is trying to invest in financial markets, there are two kinds of analysis you would typically tend to do. You either do technical analysis or you do what we call fundamental analysis. Technical analysis, like I said now, is the use of pricing charts, pricing data, market indicators to predict market direction, market movement, identify trends in those charts, and then generate trading signals for entry and exit from that investment position. Fundamental analysis is different from that. Fundamental analysis is when you actually use hard data, when you use company reports, when you use information that is available about that particular asset class or that asset that you want to invest in, when you use economic data, financial data, investment data, whatever data is available about that asset, and you use that to obtain information about the value of that asset. That is when you are doing fundamental analysis. So this is where you start to see the difference between the two kinds of analysis. One is really about generating signals, so for entry and exit. The other is about understanding the value of the asset. And that's why when I started this whole thing about training this class, I said, look, most professional fund managers combine the two forms of analysis. They use both the technical and the fundamental analysis. Why? Because to be a really sound investor in financial markets, you should understand the value of the assets that you're buying, and then you should also be able to know when should you buy it and when should you sell it. Now, typically, equity analysts in investment firms, and I'm sure there are some of you listening on this call, you will typically spend the bulk of your time doing what is called fundamental analysis. This is when you're going to take a stock of a company, for instance. You're going to run models, you're going to run regression and so on, and you're going to generate what you think is the actual value of that company, and then you're going to compare it to the market price, and then you use that to then generate recommendations, where you would say, oh, based on my valuation of this particular company, take for instance, let's imagine we're looking at again, Tesla. People will say I'm always talking about Tesla, just that I love Elon Musk. Now, you would say Tesla, for instance, you say, oh, I've done my own analysis and I think Tesla is valued at $600, and currently Tesla is selling in the market for 740 or so. So what does that mean? That means that Tesla is currently overvalued. So on basis of that, I will tell my investors to sell. And if I did my valuation and Tesla is valued at 1,005, but in the market Tesla is currently selling at 740, I'll tell my investors, or I'll tell my buyers or my research users that, look, Tesla is 1.5 valued at 1.5, but it's currently selling at 700. There's an opportunity there for you to still make as much as 700 or 600 if you buy Tesla. So Tesla is undervalued. My recommendation is buy. So that's what you spend your time doing as an equity analyst. But for an average, so when you get that, the question is, even though Tesla is currently selling at 700 in the market and your valuation says 1,005, should you actually buy Tesla right away at that price? That is where technical analysis fills the gap, because what happens if you buy at 700 and Tesla actually goes to 400? What happens if you buy Tesla at 8 or at when your valuation said 600 and Tesla was 700? What happens if you buy it, if you sell and then Tesla then decides to go to 1,000 or 2,000? What happens? Those are the gaps that technical analysis tends to fill, so that while you have the fundamental analysis on one hand that tells you what the value of the asset is, technical analysis comes to tell you when you should buy and when you should sell. So a good investor in financial markets tends to embrace and utilize both forms of analysis. Okay, so let's quickly talk about some principles of technical analysis, some things that guide technical analysis. What these are the principles that underline why we as investors should rely on technical analysis. Number one is the fact that the value of an item and the price of the item in the market are rarely ever in sync. They are rarely ever in equilibrium. They are rarely ever equal. Most times, markets can behave in certain ways that affect that cause a disequilibrium between the two. So even though you believe a stock should be worth a particular price, you've done your modeling, you've done your valuation, you've read research reports, and all of them are tending towards a particular value of what they think it should be. Markets can decide to reflect a different thing, and that's where this particular maxim that we have, that traders have in the market, where we say that look, markets can remain irrational longer than you can remain liquid. Markets can remain irrational longer than you can remain liquid. So the fact is, when you're trading in markets, you have to understand that markets are made up of people. Markets are made up of people, which is really my third point here when I say history repeats itself in markets. Markets are made up of human beings, and human beings can be rational and they can be irrational. There are times when the whole market behaves irrationally. In other words, they overreact to a particular news item or they underreact to a particular news item. And usually, if you are someone who is able to look at trends from a longer perspective, from a long-term view, you start to understand a couple of things about markets. Especially if you trade a particular asset repeatedly over a long period of time, you start to understand things about that asset that enable you profit more from that market, because you will know when the market is overreacting and when the market is underreacting to a particular news item. So take for instance those that understood that then when there are things like pandemics like this, markets tend to first of all underreact, then later overreact. Those who had started short selling. Take for instance, there was a hedge fund manager who appeared on TV in January this year and said, "Look, this is a pandemic. It's probably going to cover the whole world, and he's looking at short selling a lot of his stocks." And people were shouting on him then on that, look, this guy is just trying to create a panic. This guy is trying to profit from market because he has a lot of shorts in the market, and blah 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 and so on. This guy has made billions as we speak today. Why? Because he started all his shorts in the market as far back as January. By March, when the markets were tanking and others were just trying to sell out of different positions, he had already sold out and cleaned out a lot. And so most of his shorts were then really in the money, and they were making a lot of money then already. So um, it's a good thing to to note about markets, that look, history repeats itself in markets because markets are made up of people, and human beings, we are creatures of habit. We are creatures of habit. So we tend to repeat things, we tend to behave to particular events the same way, we tend to react to certain events the same way, and consequently, we tend to react in similar patterns that allow traders to see patterns in the market when it comes to price movements that you can use to gauge when you should enter and when you should exit from a particular asset. Now, the assets in the market are not just equities alone. You can buy cryptocurrencies, you can buy commodities, you can buy, currencies and so on. Now, and these patterns, these trends tend to repeat across all markets, and that is why technical analysis is very critical. Another thing you should understand, another principle of technical analysis is the fact that markets move in identifiable trends. Markets move in identifiable trends, trends that you can actually see, trends that you can actually understand, trends that you can actually know. And you can see that, oh, this is a short-term trend, or this is a medium-term trend, or this is a long-term trend. And you can actually ride on those trends. Let me give a good example from my experience. Back in 2006, when I was trading gold, I was trading gold for the asset management firm I was working for, and gold was at $600 per ounce. I mean, then we were trading gold and it was fluctuating between 550, and then some days it would get up to 700 and fall back to 600 and so on. And that was the range within which we were trading gold. As we speak today, how much is gold? Gold is probably in the I think gold is in the it's 1006 or 1007. Let me bring up my chart here for gold, and you can see what I'm talking about. Where's commodities? Let's bring up a commodity chart so that you can see gold. Should be on my watch list. Okay, let me put that on your screen. I don't think you can see that on your screen. So Okay, so I mean, gold was selling at a different price compared to what it is today. Let's see, gold rolling spot for gold. Yeah, 1,683. So this was gold as a then selling at that price. Okay, anyway, so what am I trying to say? That is a very that's a very long-term trend. Between 2006 and 2020, gold is now selling at 1006, and so a firm that understands that trend about gold, knowing fully well that gold is the a store of value, as viewed by many investors around the world, and that gold is also viewed that as it's a stock, it's regarded as a safe product, where if as an investor you want to be safe when markets are in a flux and you want to preserve your value, gold is what you will invest in. So you then you know that you actually want to be in investing in gold, and that's why when you look at the way gold has trended over a long period of time, say from 2006 till date. I actually don't have that chart here. Let's see if I can get that somewhere else. You will see that gold has risen from 600 to 12. So anyway, let's go back to our class, and if I'm sure I can get that later during the class. Okay, the last principle, which is very important, is the fact that fundamental analysis remains important. So you must combine the two of them. So don't forget about that. Read. If you are not someone who is in finance generally and you just still want to be a very good investor, what that means is that you should read research reports. So there are many sites, and in some of my past videos, I think I have recommended a couple of videos, a couple of sites where you can get research reports on different stocks in foreign, mostly global markets, US, UK, and so on. I don't think I have recommended anything in Nigeria, but there are so many in Nigeria. I have friends working in many firms in, that can help you. So Morgan Capital, what's the name? Meristem, Codros Capital, Stanbic IBTC, ARM. There are so many firms that publish research reports that you can read online, and you can use that to, improve your knowledge about various assets. So whatever you're investing in, make sure you are reading both the research reports about it so that you get the fundamental analysis part, and then you also add your technical analysis. So in a nutshell, that's an introduction to technical analysis, and those are the principles behind technical analysis. Now, in terms of what we'll be looking at today, let me just quickly give you a nutshell of our focus for today. We've gone through what technical analysis is. The next thing I'm going to talk about now are the pricing charts. What are the types of charts that you would typically see as an investor when you're looking at the market? Are price charts, how are they presented to you? There are basically four types we'll talk about today. And then we're also going to dive into what we call chart patterns. What are some of the trends that you can see in charts that give you an idea of what is happening in the market, where the market for a particular asset is heading, and how do you position as an investor? That is all we're going to be talking about today, and then we'll end the class after we talk about the chart patterns, okay? And I'm hoping we can fit all that within 2 hours, even though we spent over 40 minutes of our time within the first section. So I'm hoping we can do that. Let's move on. So what are the types of charts that you typically find in when you're looking at asset classes, or when you're looking at investments in financial markets? The first type of charts you're going to find are what we call the line charts. Line charts are pretty much the regular charts that are drawn up as a line, and of course on some trading platforms you would see the differentiation between when the price is going up and when the price is going down in the colors by which they represent those movements. So when the chart is going up, you would typically find it as black or green, and then when the chart is going down, you will find it as red. So that's typically what you see in a line chart. Line charts are pretty much just easy information that tells you they plot the price movement of the asset against the time. So as at the date or time at which the price was at that point. So you are typically looking at it over a long period or over a period of time, and you're seeing where prices were up or down. They don't give you a lot of information, and that's why very few analysts that are technical analysts actually look at just line charts. They look at other forms of charts, preferably not just line charts. Another one you could look at is what we call point and figure charts. Point and figure charts are pretty interesting. Why I say it's interesting, because if you look at the diagram you can see on your screen, even you can see that they look like one of these games that we used to play, X and O's. For those who used to play that game, X and O's, very interesting game. All you want to do is get your X's and your O's in a line, and then you've won the game. Now, but what this chart actually does is that it doesn't plot price against time. No, this chart only plots price against the direction. In other words, on one chart, or on the x-axis you have price, on the y-axis you actually just have up or down direction of where the chart is going. So that's why you notice there's no data at the bottom of the chart. Each of those boxes that you see are actually a set amount by which the price is moving up or down. So each box represents either, say for instance, you are the one that's going to set that box when you use this kind of chart. You can set the box to say, I want this chart to reflect every time there's a movement of 50 cents in this particular asset. So when there's a movement of 50 cents upward, you get an X. When there's a movement of 50 cents downward, you get an O. And that's why the X's are green, the O's are red. So every time there's and if the price movement is not even up to that amount, you still get that box, just telling you that it's within that range. So for instance, let's imagine you set a box size of 50 cents and the price moves by 80 cents. You get two boxes. Okay, if you set a box size of 50 cents, for instance, and the price moves by $1, 18 cents, you still get your five boxes, or sorry, your three boxes. Yeah. So that tells you how price is moving. So people that use this chart typically, and of course in mostly a lot of Asian markets, this chart only tells you how price is moving in the market. That's what it's good for. It tells you so that you're not really looking at time now. You're just trading movements in prices, and you can see exactly by how much prices are moving. That it tells you that information. It doesn't tell you anything else really, but it tells you price movements very well. Another type of chart which is very popular in the market among traders is the bar chart, and I particularly like bar charts. They're not like my top number one type of chart, but I like bar charts because they give you a lot more information about the prices in each trading session. So each of the charts, each bar that you see right there represented actually represents a trading session, so that as at this time when there was a trade in the market, this was the information about that trading session. it tells you that, okay, this was the price at which that trading session started, which we call the open, and it tells you that this was the price at which that trading session ended, which we call the close. And this was the highest price that was offered in that trading session, which we call the high, and this was the lowest price that was offered in that trading session, which we call the low. So you can see all that pointed out on the chart. It tells you a lot more information about that chart, and you can see that the height or the charts are different because the highs and lows are significantly different. So also the opens and the close. The closer those things are, the smaller, the shorter the bar, and the farther those things are, the longer the bar. Bar charts are pretty interesting. At the same time as telling you all that information about prices, it is also telling you information about the time. So it's plotted on a graph on an axis, an x-axis of price versus the y-axis of time. So within each time session of trading, you know what the opens, what the close, what the high, and what the lows were. So it's pretty interesting, and I think it's one of the charts you should always look at when you're trading in the market, especially if you're doing technical analysis. Okay, and this brings us to the last type of chart, which is the darling of all traders. This is the candlesticks. Candlesticks are quite old. They've been used since the 1800s by rice traders in Japan, commodity traders in Europe, mostly from in Asia when they started trading rice on the commodity exchanges there. And one of the interesting things about candlesticks is that candlesticks are pretty much some of the most loaded types of charts that there are. They tell you everything that a bar chart tells you, which is highs and lows, opens and close, but they also give you volume information so you know how much volume is in the market at that time. How many people are at the high, how many people are at the low, how many people were at the open, how many people were at the close, and so on. And that is why in candlesticks, and if this were an advanced class, we would also be talking about different types of candlesticks, because the candlesticks are in different forms. There's the hammer, there's the rolling pin, there's a rising star. There's so many types of candlesticks that you can learn about. They also give you a lot more information about those assets or the trading session within that particular time frame when the trade was done. So you could actually learn so much about candlesticks, and if we get on to the advanced class, I will dive into a lot of that as well too. But for today, it will suffice to know that candlesticks charts are the darling of trading, and if you're going to be a trader in the market, you want to use your candlesticks. So candlesticks also, again, the green bars represent upward movement, the red bars represent downward movement. Okay, if at this point you have any questions, please let me know. I'm constantly looking at the chat window, so if you have any questions and you want to ask questions, please feel free to get on the chat window as well. I'm just going to quickly respond to a couple of questions. Here. Okay. So if you have questions, please feel free to respond, to ask them on the chat window, and we will keep on talking there. Okay. Now, let's move on. So now that you understand the different types of charts that you would see in markets, you typically would prefer to, most trading platforms will give you an option to choose the kind of chart you want to see. So if you look at your trading platform, you'll be able to change the view and see the type of chart you want. Okay. Now there's something we talk about in the market, which is the next thing that you need to learn, which is called support and resistance. Now, you remember what I said when I was talking about the principles of trading, and I said that human beings are creatures of habit. We tend to repeat a lot. We tend to repeat our attitudes to events, our reaction to events, and as a result of this, our mindset about value, we tend to ascribe value to things, and at times it is in unison that all of us would decide that this is where we think this this thing should be priced. And also because the amount of capital that we all have in the market is at different levels. Traders with larger amounts of capital are able to create, levels beyond which nobody else wants to trade, because they can see that even the large guys in the market are not trading below or above that level. Those price points are what we call your support and your resistance. Your support or your resistance are psychological price points at which assets tends to form a floor or a ceiling, beyond which markets tend not to trade, or tend not beyond which they tend not to trade, either above or below. Now, let's go into that. Before something is called a support or a resistance, usually we expect that price charts would touch that point 2 or 3 times. I like it when it's at least a minimum of 3 times. Um, Sometimes it's just 2.2 times you get. So take for instance, if you look at the chart on your screen, there's a resistance level here that has been touched by the price chart twice, while there's a support level that has been touched by the price chart about 3 or 4 times. Okay, so at the bottom of the where the price point has touched 3 times, that is what we call the support level. What that means is that that is a point where people tend to feel that asset has fallen enough, and they tend not to want to trade below it. Okay, while the resistance is a point where traders feel that the market has risen high enough, and they also don't want to trade above it. So assets or investment positions tend to alternate between these two, support and resistance. But they also tend to break them also too. Now, when a support level is broken, that support level automatically becomes the resistance level, because once it is broken, then it takes a while for price to want to rise above it again, and prices tend to fall to the next support level once they break one support level. So oftentimes, as a trader looking at markets, the first thing you need to establish are, where are the supports and resistance for this particular asset I'm interested in, so that you know if you are buying this asset close to the support or close to the resistance. For instance, if you're trying to buy an asset so that it will rise in price and you will gain from the increase in price, then you want to buy closer to a support, so that if it bounces off that support, then you know that it's heading to the next resistance level. And if you are in a market and you are doing what is called shorting, which is you actually want to profit from when the asset is crashing. In other words, let me quickly explain what shorting and how shorting works. Shorting is when you borrow quantities of a particular asset from a broker. Now, you are borrowing quantities from a broker, not an amount. You are borrowing quantities. Take for instance, let's say you want to short crude oil. So you borrow, let's say, 20 barrels of crude oil from your trader, your broker rather, and your broker borrows you 20 barrels. That 20 barrels is trading at, let's say, $20. So you have borrowed $400 worth of crude oil. You automatically sell that in the market immediately at 400, and that 400 goes into your account, but it's not credited to you. When the market starts to crash, and let's say crude oil crashes to $15, and then you go back into the market and buy 20 barrels of crude oil at $15. Now you spend just $300, and you return the $20, 20 barrels of crude oil back to your broker. What you borrowed was 20 barrels, what you return is 20 barrels. But you sold it at 400 and you bought it back at 300. The difference of $100 is your profit. That is called shorting. You can do that with commodities, you can do that with equities, you can do that with currencies. Okay? Now, I mean, you probably wonder, oh, currencies, how do you do that with currencies? Because after all, it's also an amount as well too, right? The thing is that when currencies also drop as well too, and their value tends to drop, the value at which you sold, the difference between the value at which you sold and the value at which you bought back still remains your profit. Okay? Now, so you sold, and that's why in currency trading, you are selling one currency against another currency. What you borrow is one currency, you sell it in another currency. So for instance, you can borrow 1000 USD, okay, and you sell it in naira. So 1000 USD sold in naira, let's imagine you converted it in naira at 400 or whatever the price is in the market now. Here it's around 415 or so. Let's imagine you sold it at 400, so you get 400,000 naira. Then naira starts to actually appreciate. So USD then falls down all the way to, let's say, 300 naira. Okay, it falls to 300 naira. You go back and buy 1000 USD at 300 naira. You spend only 300,000 and you return the 1000 USD you borrowed. The difference between the 400,000 and the 300,000, 100k, is your profit. That is how you short in currency markets. So you don't short against just one currency. You short the one currency against another currency. So you can short in various markets, be it equities, commodities, cryptocurrencies, or currency or equities as well. So those four major markets: cryptocurrencies, currencies, commodities, and equities. And you need to understand supports and resistance. So let's look at another chart. This is a Euro USD chart, for instance. In other words, you are buying the euro and selling the USD. So and you can see the clear support here. This was from 2001 to 2012, or 2007 to 2008 rather, in terms of time chart, the time axis, and the highest level that this price ever got to 1.488 euro, $1.488 per euro. That is the highest. And beyond that point, you see that the market doesn't want to sell. There are a few people that offered prices above that range, and you see those tall thin lines, but really there was no volume. Nobody was ready to sell at those prices. So you can automatically see, no deals were done at those prices, rather. You can automatically see a clear resistance in the market at that point. And so if you are trying to buy euro or you're trying to sell the USD, you know automatically that you cannot buy above that price. Okay? And if you see the market at that price point, you automatically know that it's also likely, unless there's a strong fundamental news or data in the market that affects this particular currency pair, there is nothing that's not going to make that price not bounce off that resistance and come down. So if you know that you are in the market and the market is close to that resistance point, you are looking to sell, not to buy. Okay, you're looking to short, not to go long. Okay, I can see a couple of questions. Okay, good. I can see a couple of questions, and let me just quickly answer those. Someone is asking that, please, could you share sites for research reports, again, preferably foreign? Okay, so I'm just going to refer you to my YouTube page. If you go to my YouTube page, look for the video on buying foreign assets. I recommended research sites there. For screening stocks. So if you go to that video, that should answer that question. Finviz, Yahoo Finance, those are Zack Capital, Finvox. There are so many of them. You can use all those sites, and they all have free research reports published by equity analysts from various houses on different commodities. So on the same equity, you can find like 10, 11 research reports which you can read for free. Yahoo Finance, Finviz, very good one, Zack's Capital, and so on. Okay, someone is also asking, what about fixed income? Can you do the same thing with fixed income as well? You can short a fixed income as well if it's traded on an exchange. So if it's traded on an exchange, yes, you can short it. But if it's not traded on an exchange and it's only available from the primary dealer itself, from the primary issuer, I don't think you can short it. Um, Except of course it's traded on the exchange. So it's the exchange, the fact that it's traded on the exchange that gives you that ability to actually short it. So that's very critical. Someone says, what if the price goes against you? You owe your broker when shorting, which is very true. Pretty much like the way when you are buying low and trying to sell high, if the price goes against you as well too, you also lose your money. Now, when you are shorting, what you are taking advantage of is a service by your broker, which comes at a fee. So there's also a fee charged for that particular for shorting in markets. And if you are shorting on trading platforms that offer derivatives, products like this, you could even run the risk of losing more than you actually invested. So that's why when you're shorting, you actually have to protect your trade. You have to have all sorts of securities in place to ensure that you don't lose more than you actually want to lose, or more than you can actually afford to lose. And if we're taking the next class, we'll be talking about strategies for protecting your trade in the market, for protecting yourself when you're investing, different ways to cover your position to ensure that you actually try don't lose when you're trading, or you don't lose too much when you're trading. We'll talk about that in the second class when we're trading, which is why you have hedge funds anyway. Hedge funds, they never trade naked. When you work in a hedge fund, one of the first things you learn is how to protect your position. Every position must be protected. When I was trading for an asset management firm, you don't trade just one market. You place a trade in one market, and then you place a counter trade in a different market that helps you to protect positions in that market. So, for instance, most of the time when you're trading in gold, or you could also be trading in a currency pair of the USD and the Australian dollar, or when you're trading in crude oil, you could also be trading in a currency pair between the US and the Japanese yen, because those are counter trades. Because the Japanese economy is a very significant oil consumer, higher crude oil prices affects the value of their currency. So if crude oil prices are going high, the value of their currency is coming down. And if you're trading, and if crude oil prices are going down, the value of their currency is going up. So those are counter trades that you often will do. There are several strategies. There are collars, there are options, there are just limits as well too that you can just place on your trades, which could help you protect your position. But that's not for this class. We'll be talking about that in the second class. So that that's how hedge funds make money. In every market, they protect their trade. So we'll talk about all that. Now, someone also asked, is there a time limit for shorting? How long can you hold the asset for before returning? Fantastic. So, you can hold the asset for as long as the market is in your favor. You can short a position for as long as the market is in your favor. There are people that shorted Tesla and came in from when Tesla was in 800 level and shorted it till Tesla fell to 300s and so on. So you can short for as long as the market is in your favor. The moment the market turns against you and you're losing your position, your broker will call you and tell you to end your position, or they will forcibly end it for you, so that you actually don't lose that position. So you do want to ensure that when you actually want to short, you don't short for too long. There is, just like you can hold a stock for as long as you want, you can hold a short position also too. But of course, that will affect the fee that you also end up paying, because don't forget, it's a loan. You borrowed a quantity. So pretty much like a loan of anything, money, asset, or whatever, there's a fee charge per the duration for which you held the asset. So shorts should actually be short. And don't mind the pun, but a short position should actually be held for a short period of time. So try not to hold shorts for too long. There are people that short assets and they hold it for, if they have the capital, for years, but most times people hold shorts for just a short period of time. Okay. So someone says, would you consider repo markets as a shorting opportunity? Repo markets as repurchase, an opportunity, repurchase markets when, I'm not sure the repo market you're referring to here. Maybe you're referring to the ones by central banks, when central banks repurchase bonds from financial institutions, banks mostly, or are you talking about general repossession of assets and so on? I don't know. But if that's what you're referring to, are they a shorting opportunity? Not in my experience. I now I don't claim to be a full authority on all markets, but in my experience, not necessarily repo markets. I don't see them as a shorting opportunity. Someone's asking what drives support and resistance levels. What drives support and resistance levels? That means you're probably just joining the class. But if you're not just joining the class, you would understand that, as I said, support and resistance levels are psychological price points. They are price points in the minds of traders in the markets where they feel this asset is tapped out. In other words, we shouldn't buy above this price or we shouldn't sell below this price. So a lot of traders in the market reach that point in their mind and they decide, no, I don't want to sell anymore beyond this point. And because what I told you earlier, I said, look, human beings, we are creatures of habit. So consequently, we tend to react to events in a similar pattern. And that's why when prices get to a particular point, everybody just decides, nah, I don't want to sell above this price point. I don't want to sell above this price point anymore. And so everybody just decides to stop selling, or everybody just decides not to offer any price above that point or a price below that point. Okay. So, and then of course immediately it should be apparent to you that resistance points tend to be driven mostly by buyers. Nobody wants to buy above that resistance point, while supports tend to be driven mostly by sellers. Nobody wants to sell below that point. So you tend to see that in the market. So that's a bit of explanation on what drives support and resistance. So questions answered, and moving on. So we've talked about the price charts. We've talked about the resistance and support levels. In fact, you know what? Let me quickly show you some resistance and support levels in some real life charts. Okay, let's go back to some real life charts. I think we still have just a little bit of time to do that. Should always remember to bring in this video so you can see that. And now, so let's go to this price chart and let's look at this. This is Bitcoin actually from a different platform. Should I use gold? No. Let's see. What do I have here? No. Okay, let's look at I think my number one commodity that I'm always talking about. Let's look at crude oil. So on this platform you can also buy crude oil, and it's traded as a future product. So you can buy, you can sell, you can short, you can do all sorts with it. It's quoted in cents, and so you can see 2842 is currently selling at $28.42, but in total 22,842 cents. So that's why it's quoted in that price. And if we look at this chart, I'd like to show you some supports and resistance. Okay. Okay, so again, just to remind you, this class is sponsored by this particular website we're opening, which is Eagle Global Market. Eagle Global Market is a global trading platform that allows you to access global markets for equities, for commodities, for currencies, and for cryptocurrencies. The platform provides derivative products, contract for differences, products that allow you to actually buy different kinds of assets and trade them real time in the market. It's a derivative platform, so you should understand how what you're trading and understand that you can make just as much as you can make fantastic returns. You can also be exposed to the risk of losing even more than you've invested because it's a derivative. So have good knowledge, trade when you're trading on this platform, and we also have demos which allow you to test out your trading strategies against real-time prices, but not with real currency, just paper trading before you actually trade in live markets. So there will be a link to register on this platform and trade. And in the last class, what I did was the first 10 people that registered on this platform, I had their accounts credited with 10,000 Naira immediately. You can trade in Naira on this platform, so that's another fantastic thing about this site. You don't have to worry about currency exchange and all that. You can put your Naira and then you can trade global markets. So the accounts were credited with 10,000 immediately. So, and I think I will extend that offer for this class also. The next 10 people to register, create the accounts with 10,000, and you can use that to trade any currency you want. But I'll also send you a link to set up a demo account, and then you can use that to test out your trading strategies before you actually start buying whatever you want to buy in this market. Okay. Crude may not necessarily be the best because it's trading. We're trading month to month, so all the data you get is from one month to another, not necessarily across months because this is a future, so it's a monthly traded product. Let's use shares. Let me go to my watch list and let me use maybe the gold that we already have open. So I'll look at gold from a 15 minutes price chart. Now, this is another wonderful thing about charts, which you should know, in the sense that you can alternate the time frame between which you want to look at the chart. You can look at charts over 15 minutes, you can look at charts over 1 minute, depending on how long you want to trade. So if you want to trade over a longer period of time, you want to look at a longer view of price movements. But if you're trading short-term trading strategies, which we'll talk about later, if you're trading short-term trading strategies, then you want to look at a shorter time frame, because it's the price movements within a shorter time frame that matter for you as someone who's trading over a short period of time. Now, if you look at this particular chart in your window right now, you can see that there's a support level here at 1684, automatically 1684, and there's that price there, there's that support level there. There's also a support level there's also another support level somewhere here as well, also around 1690 thereabout. So this is a real chart for a real asset that's trading in markets, even though today is a Saturday, so it probably isn't live anymore, but that's a real support level at 1684 there. And if you come up a little higher around 119, there's also another support at that level. That's how supports work. Whereas at the top level here, let me draw a line so that you can see that clearly. Around here also there's a support as well too. See, around here there's also a resistance level somewhere around here that the price has touched twice, and it was once a support, but it became a resistance level, and prices touched it and just never went back down. So if you can see that, you can see that it was a support that became a resistance, and once price fell below it, price never recovered back to that point, and that was at 1719. or let's just say 1720. So that's another support level. So when you're trading assets, one of the first things you want to spot out is what are the supports and what are the resistance. Okay, I see questions like, what are the requirements to trade on the EGM platform? You just need to register, and you provide them with pretty much like how you register for a bank account in Nigeria: utility bill, your identification card, and that's pretty much it. Now, the good thing about this platform is that they provide you with trade signals. They tell you opportunities that are in the market, and they give you when to buy and when to sell, so you can use their trading signals as well to profit from the market. Oftentimes I just tell people, if you don't want to do a lot of research or stuff yourself, just talk to them. They'll guide you, they'll teach you, they'll tell you, okay, this is what we are buying in the market, or this is what we are selling in the market, this is the price at which we're entering and when we are buying. So they'll issue all those signals, and they also do a lot of trade seminars and webinars online, which you can profit from. So again, you can check them out. How secure is the platform? I've used it for 7-8+ years, and I think it's pretty secure. I haven't heard any stories that people lost money or so on. And once you ask for a withdrawal, you get your withdrawal in a couple of days. So it's pretty as secure as they come. Here in Canada, I tend to use, for foreign assets, I use a different platform. This is Webull, which is a US-based platform that trades foreign commodities. You can use foreign equities. You can use them also if you're based in this side of the world. But if you're not based in this side of the world, I don't think you'll be able to register with them. But those are pretty much the two platforms I tend to trade on: Webull or Eagle Global Markets. Okay. So that said, let's move on to the last bit of this class, which is chart patterns. Okay, let's move to chart patterns. Okay, so chart patterns it is. So what are chart patterns? Chart patterns are actual, trends in prices that you can see very clearly, that give you more information about where prices are headed, where prices are going. And when you see these chart patterns, they give you a information about, okay, this is where this asset is headed, and then you can use that to judge where to enter and when to sell. Okay, don't forget, most times these things all boil down to supports and resistance. That's why the first part of understanding chart patterns is understanding what is the support and what is the resistance. Everything else falls in between. Okay, so let's look at some of these chart patterns. The first one, which is pretty much the most obvious, is, well, because it bounces off a support, is what we call the bottom. There are double bottoms and there are triple bottoms. Double bottoms or triple bottoms are points when prices will bounce off a support twice. Now, it is a sign of an upward trend. So when a double bottom happens in the market, it is usually a sign that the market is about to head in the opposite direction. How you know that you're looking at a double bottom is when you look at the neckline. You can see that there's a very clearly established neckline that shows that this particular bottom, the bottoms are within the same level, they are bouncing off the same support, and the neckline is also pretty much almost parallel to the bottom that it's bouncing off. This is a clear example of a double bottom. If it were a triple bottom, it would be the same principle. It would be bouncing off a support line 3 times, and you could see a very clearly established neckline that is sort of parallel to the bottom. Now, the moment it breaks that neckline, that is when it is confirmed to be on an upward trend, and that is usually, if you are trading using this double bottom signal, that is usually the best time to buy. Do not try to buy at the bottom. Do not try to buy when the market has just turned at the bottom. Why? Because if you buy at the bottom of a double bottom, what if it's going into a triple bottom? Okay, what if news comes out that then changes the direction of the stock as well too? So typically the safe point is when the uptrend is confirmed, and that's why you buy at the neckline. Okay, if you're buying using a double bottom, if you're in a market that's trading and there's a double bottom, you typically would buy. Now you could do the same thing. There's also the opposite of this, which is called a top. You can have a double top or a triple top. The top is the reverse, when it bounces off a resistance point, and that is usually a sign of a downward trend. That is usually a sign that the market is about to change direction and go down. So again, you typically buy when it breaks the neckline, okay, or you sell rather when it breaks the neckline. So if you are holding that position and you want to get out, once it breaks that neckline, that's when you want to jump out. Okay, another chart pattern you see in markets is what we call triangles. Triangles are unlike bottoms, where the neckline and the bottom, or the top line and the neckline, are typically parallel. With triangles, they occur in a triangular form. You can literally draw a full triangle just looking at it. So for instance, you have three kinds of triangles. You have three kinds of triangles. You have the symmetrical triangle, you have the ascending triangle. So at the top of your screen right now, you can see the symmetrical triangle, where if you plot those two lines to the end, you notice that they join at a point, and they look like this top chart that they're going to look like this top chart that you're looking at here. And the guide in using this chart is, you can see clearly that the market is, or at the top line is heading downward, the bottom line is heading upward. That's a triangle. The trading guide typically here, when trading triangles, is you wait until they break out. You wait until they break out of the top line or the bottom line, because with a symmetrical triangle, you could be heading upward or downward. That's the thing about a symmetrical triangle. You could be heading upward or you'd be heading downward, and you don't want to trade until a direction is established. So you plot your lines on the asset chart that you're looking at, and you wait for the price to break out. Now again, in advanced trading, there are tools that you can use to program that in such a way that the moment price breaks through your line, there's an automatic buy of that asset. Those things are called robots. They are algorithms that you can program into your trading platform that buy and sell on your behalf, so that even when you are not watching the market, those things are buying and selling for you. Okay, advanced traders use that a lot, especially if you're trading huge amounts of capital. You don't have time to monitor all the markets you cover 24/7. So you set up those robots, you set up your indicators or your chart patterns that you want to trade off, and then program those robots. Once those signals are generated, that look, for instance, I'm trading let's say I'm trading a stock that is trading in a foreign market. I'm trading Alphabet, Google, or Microsoft, or Facebook, or something, and I've set up and I can see a triangle forming in the price chart, and I see that, oh, it's a symmetrical triangle or it's an ascending triangle. I set up my lines and I tell the robot that, look, the moment this price point breaks out of this line, buy. And if I stand up from my trading station, I go to the washroom, I go to have lunch with friends, if the price actually breaks out of that line, the robot will automatically buy the quantity I've asked it to buy, and it will stay in the market until my sell instruction kicks in. Okay, so traders do that. But if you're monitoring your market and you see a triangle, that's how you typically would trade off a triangle. You wait for the breakout point and you buy off the breakout point, and if it's heading downward, you sell off the breakout point. Okay, that's typically the way to work with triangles. So that's it. You've seen a symmetrical triangle. The bottom line is pointing up, the top line is pointing down. But with an ascending triangle, you can see that the top line is sort of straight. Okay, you sort of have a straight line at the top, but you have an ascending line at the bottom. Okay, whereas for a descending triangle, it's the bottom line that is straight because it's a support, and then the top line is actually descending, and you can see that the market is heading downward. Now, typically, and I'd say like 90% of the time, an ascending triangle will break out upward, while a descending triangle will break out downward. But it does happen that a descending triangle will switch direction and break out upward, or an ascending triangle will switch direction and break out downward. Usually, there's some data or some fundamental news that has happened that changes the direction of the market. Which is why, again, I told you, you know what, you need to combine both the fundamental and the technical. So, for instance, when I was a trader trading for an asset management firm, I used 3 screens. Now, you have your trading platform on one screen. You have all your data, your fundamental news. You have a news feed about that particular asset. You have a live news report from CNBC or CNN or whatever Bloomberg News, whichever news channel you follow, still on that same screen. And then on the third screen, you have all your Microsoft Office, Microsoft Excel, and all the other screens, other things that you need to do for the markets that you're covering, your positions in Excel and so on. You have that open. So that's why when you see proper trading floors, you see that most traders have like 4, 5, 6 screens and so on. They are trading. Why? Because you need to monitor the market using all that information. So as you're trading, you shouldn't see a breakout happen and you're wondering, why is this breakout happening? Because you're constantly looking at news also too. You're seeing that, oh, this is what's happening, or this is what's going to happen today at this time, and you can see that, okay, it might affect my asset in this way or that way. Oh, Tesla is going to release results next week, and market is already trading ahead of that results because people are hearing feelers that, oh, they are selling more cars, they are doing more repairs, so they are able to produce more parts and so on and so on, and you can see prices reacting to that already. So that explains the ascent that you're seeing in the ascending triangle or so on. You should be able to do that. So it's important you combine both fundamental and technical. That's my point there. Okay, so and then pretty much like I said, the guide here is your trading breakouts. Another formation you see in markets are wedges. Wedges are very close to triangles, and you can see that the lines are almost going to touch. It takes a longer time for those sort of lines to touch. They probably never touched during that trading session. So wedges tend to be a signal of continuation. They typically signal that price is continuing in the direction they are facing. You rarely find a wedge on a straight line. You tend to find wedges either going up or going down. So it's either a rising wedge or a falling wedge. And at the bottom of the screen here, I put a Tesla chart. This was when we had the last class, I think last week. This was the chart for Tesla, and I told people that, oh, Tesla is on an upswing, and Tesla is going to keep on rising. And as at the time we were talking, Tesla was 573. As at today, Tesla is 760. That's like $200. And pretty much almost 50% gain in Tesla. So wedges are pretty good signals also in the markets. The two lines are not parallel. They are typically ascending. One more sloped than the other. The top line typically is usually either, if it's a rising wedge, then the top line is not as sloped as the bottom line. The bottom line has a higher slope, whereas if it's a descending wedge, then the top line has the higher slope, while the bottom line has a lower slope. But wedges are a signal of continuation of direction. You typically want to trade a wedge either at the breakout point, or if you're using an indicator, the indicator will tell you when to trade the wedge. If you want to trade it at an earlier point. This is a good point to also mention that if you are trading using technical analysis and your fundamental analysis, of course, you still want to make sure that you're combining a clear chart pattern with a market indicator that tells you, okay, it's a good time to enter or it's a good time to exit. Okay. Don't forget, if you have questions while you're watching this, feel free to ask the questions on the live chat stream. I'm constantly looking at the live chat stream to review your questions. Okay, fun with flags. Another chart pattern you can look at is flags, or what we call pennants. Flags are with flags, you can draw two parallel lines in the direction in which the market is moving. So you can see a clear resistance and a clear support in the chart, and that tells you that the price is continuing in that direction. Pretty much like all those above it, you are trading breakouts here. You're trading breakouts. Okay, so once a flag is established, it means the market is moving directly in that direction. A flag could be an upward flag or a downward flag or a straight flag, a sideways flag, which is an indication that market is just trading up and down in a very clear direction. It's just going sideways. There's no upward or downward movement. If you are trading a sideways flag, then it tends to be breakouts that you wait for. You could trade it at an earlier point if you have an indicator that tells you otherwise. For instance, with a flag like this, you could trade small, you could jump in for short, gains, or what we call scalping. If you're an established trader in forex markets, there's a strategy called scalping. Scalping is when you target small movements in prices. So you could target maybe 10-cent movement in prices, or 20 pips or 30 pips, and so on. Every price point by which the chart moves is what we call a pip. Okay, every price point by which the chart moves is what we call a pip, and that pip usually means anything from 10 cents to as high as $10 in various markets. Okay, so scalping is when you target small pips. When I was trading for an asset management firm, our strategy was scalping and then some swing trading as well. With scalping, we had a group of traders whose responsibility was just to target maybe a small amount of dollars every day, and so we're constantly making those dollars every day. And then we had more experienced traders who were doing swing trading, where they knew broad market swings and they would plug in their trades at the bottom of the swing and ride the swing either to the end of the bullish trend or to the bottom of the bearish trend. So swing trading and scalping are different strategies that are used in markets, and you can target. So when you're trading flags, for instance, you might want to scalp because there's a defined upward and downward trend and you're trading within that window. You jump in at the bottom, jump out at the top, sell at the top, jump out at the bottom, and so on. So you could trade all that. So flags are two parallel lines that you can see a clear support, clear resistance in the market, either heading downward or heading upward. The chart at the bottom of your screen is IAU. That's a gold ETF that I occasionally trade. It's a gold ETF, and pretty much like gold, it follows the price of gold in the market, and it's a safe commodity. So that's why you notice there was a bit of sideways trading for a while, and then when market started to realize, look, this market is too volatile, people started jumping out of equities and commodities into gold, then the market started going up and there was a breakout. So that breakout is a good point, and this was as at a week ago as well. The price chart is a lot higher if you check it today. Now, this is one of the most confirmed. This is one of the most confirmed trends for price patterns that a lot of people trade off in the market. This is pretty much the most popular one: heads and shoulders. It sounds like a dandruff cream, but it's a pattern for trading in markets, which is one of the strongest signals you can get when you're trading. Head and shoulders is when you have a very defined low point or high point, which is the head, and then you have two low points or high points on alternate sides of that head, which are called the shoulders. That is usually a sign of a reversal. Once you get a head or a shoulder like this, the shoulders are always aligned. So the shoulders should always be at the same height. The shoulders should always be at the same height, but the head has to be taller than the shoulders in whatever direction it's facing. So on your screen here, you have at the top of the screen, you have an upward facing head and shoulder, which is a sign that the market is about to go down. And at the bottom of your screen, you have a downward facing head and shoulder, which is a sign that the market is about to head up. Okay, how you know again that this is a clear head and shoulder is I've given you a couple of things. Number one is the head is taller than the shoulders. Number two, the shoulders are at the same level, at the same height. Number three, there's a very well-defined neckline. Well-defined neckline between the shoulders. So you can see that. Okay, now markets are funny, and let me tell you a couple of experiences. Number one is that the head could also be made up of, it could be a hydra, a triple-headed dragon, or a double-headed dragon, or a single-headed dragon. So at times even the head can be in three different charts. Okay, you could have a head that is made up of three different heads, or two different heads, or a single head. But the shoulders are where you know that, okay, these are clearly two shoulders, and this is a triple-headed dragon, or this is a double-headed dragon, or so on. So heads and shoulders, the first, you are looking for the head, quite all right, but you also want to look for the shoulder. Okay, the shoulder tells you a lot more about the head and shoulder chart. The shoulders should be at the same height. Now, I say this because when the experience I've had with markets is that, these patterns, there are principles behind them, and those principles never really change. But the pattern in which the price chart will show up may differ. So that's why I'm telling you about the multiple-headed dragon, or double-headed, triple-headed, and so on. Typically, you find just one head, but oftentimes you may find two heads or three heads. So do be careful that the what you're looking at as a triple head is not actually are not two shoulders, okay, but clear heads, okay, and then they are taller than the shoulders on the side. Now, trading heads and shoulders is, you trade at breakout points also too. You trade when the moment the shoulder is confirmed and it's breaking out of the neckline. That's when you fire. That's when you pull your trigger. Okay. You don't want to pull your trigger at the bottom of the shoulder. You wait until the shoulder is fully formed. You don't pull your trigger at the head. You wait until your head and your shoulders are fully formed. So someone is asking a couple of questions here. Um, says, I see, when is the class for fundamental analysis holding? Okay, fundamental analysis. Yeah, we can look at possibility of holding a class for that as well at some point. That would be interesting. That might be a much longer class, because with fundamental analysis, you're basically looking at valuation, which is Excel, which is research reports, and so on. We can look at the possibility of doing a fundamental class. Someone is also asking, as an aside, what happens if you lose money for your firm? Sounds like an interesting job. Okay, so like right now, most of what I do is buying investments for clients when they want to buy, suggesting ideas, trading ideas, and then again, I work with a trader who is the main relationship manager for those accounts, and does most of the trading on those accounts also too. Um, I don't do pretty much like what I used to do for the asset management firm when I was in Nigeria. I don't do that much. But then when I was trading for the asset management firm, did I lose money? Of course, you lose money. Um, some firms will have a strict policy that if you lose above a certain amount, you get deducted from your salary. Some firms, it's markets. If you lose some, you win some. As a trader, you try to ensure that you cover your losses. When there are losses in the market, you try to make sure you cover them back again. And that's why you trade with protection. And that's why when you see a trader, and when I'm talking about trading, I should differentiate a bit from an investor. There are two different players: a trader and an investor. A trader tends to take short-term positions in the market, while an investor will buy an asset and hold it for a long period of time, oftentimes till maturity. So if you are buying equities, for instance, now you're not trading derivative products; you're actually just buying equities. You can hold your position for as long, and the only thing you can lose is the value of the equity. Okay, so if you're buying an equity, you're just buying the equity, just the equity, and you can only lose that amount you invested in that equity. Okay, so if you buy an equity, if you make a loss, if the only loss is when you sell. Okay, if you hold the equity till the price changes again, then good, the price changes. It only becomes a loss once you sell it at that losing price. So that's typically how that works. If you buy an asset for an investor and they lose money, yes, it becomes a fiduciary issue if you didn't do your research properly and you advise a client to buy a losing asset. You could actually get sanctioned by law and all that on this side of the world. Okay. Someone is asking, is it necessary to wait for a retest before trading a breakout? Okay, so again, that boils down to strategy. What exactly is your strategy? Someone is asking if I want to buy at that breakout point of a head and a shoulder, should I wait until price sort of falls back to that breakout point before I buy, or should I just buy instantly at that breakout point? How strong is that breakout? That's where an indicator will come in. So for instance, there are market indicators which we'll talk about in the next class that often can tell you the strength of that breakout. If that breakout is a very strong breakout or if it's just a weak breakout. There are stochastic indicators which can tell you that. There are moving averages which can tell you that. There are all sorts, which again we'll talk about. But the breakout is what you want to target. Okay, the breakout is what you target, and then you want to add an indicator to then check how strong is that breakout. Is it a strong breakout? Is it a small breakout? Is it a breakout that I should just ignore, and so on? Because you could trade a breakout and it's actually just a weak breakout, and so it doesn't rise too far, which means you have to constantly monitor so that the moment it starts to change direction, you sell your position and jump out of the market. Okay, I'm showing you a chart here for Franco Nevada, which is one of the pipeline laying companies on this side of the world. It is one of the assets that we typically recommend for our client portfolios. It's pretty strong, and you can see a very clear head and shoulder here at the bottom. You can see the shoulders here on this side and on this side, and then you can see the head at the bottom, which is 110.99. So that's a clear head and shoulder, and this chart will keep on heading. The moment it came out of the neckline, that would have been your buying point, somewhere around 112 above, and then you ride it up until it gets to wherever it's going. And you keep monitoring that so that you know when the market is turning. This was as at last week. If you check the price as at today, let's see. Franco Nevada, where are you? FNV. Okay, it's currently 124. So if you came in at that 112, you would currently be $12 to the good, which is almost about 10%. So not too bad. I reckon that this particular trade could go as high as probably 125 ish. Yeah, probably about 125. So not a bad price. Let's look at 15 minutes window. See where the top point is. Oh, 127. It goes as high as 127. So who knows? You may be able to get up to that. But I mean, I'd probably set my exit point somewhere around 124 to exit the market the moment it touches that. And when we get into trading strategies, I'm going to give you some ideas around principles for trading. You tend to be very aggressive when you're taking your profits and cutting your losses. So I take my profits fast, but I also take my losses a lot faster. But that's a trading strategy. So you may not make as much profit as those who. There are risk takers that are willing to ride a bull all the way into the pen. The market is going up, and they will follow it to as high as it wants to go. If you are playing with safe capital, sure, you can do that. When you're playing with client funds, you want to ride a bull up to your profit target, and you jump out. Okay. Anyway, that is. Oh, sorry, I didn't show you this Franco Nevada screen. Let me show you this Franco Nevada screen, which I'm talking about. Sorry. Here you go. This is Franco Nevada. Like I said in the last class, we were looking at this stock when it was at the bottom here, and there was a clearly defined head and shoulder. It's currently 124, so if you came in at 110, that would have been fantastic. Let me see, FNV on the TSC.
So it could still be heading to a higher level on the Toronto Stock Exchange. That's the TSC. Now, the interesting thing about this side of the world is, you can trade an asset on the Toronto Stock Exchange here in Canada, or you can trade it on the New York Stock Exchange in the US. Um, you can buy in Canada and sell on the US. You can buy in US and sell on Canada, and it allows for a lot of interesting things because you also have to factor in exchange rates. And if you see that there's actually you can make a gain or a loss on the arbitrage between the exchange rate or the price of the commodity as well. So it's always interesting. Allows you to do all kinds of interesting things on this side of the world, which you're constantly trying to ensure that you help your clients benefit either from the arbitrage on exchange or the arbitrage on the price itself between markets. In Nigeria as well, too, when I was in EcoBank, I know our investment management business, they did a lot of arbitrage on stocks that are cross-listed across markets in Africa. So, for instance, you can actually buy EcoBank stock in Nigeria Stock Exchange, and you can sell it on the Cote d'Ivoire Stock Exchange, or you can buy it in on Nigerian Stock Exchange or in Cote d'Ivoire and sell on the Nigerian Stock Exchange because it's cross-listed. It's the same company, it's the same stock, and you can buy it across markets. And so there are a lot of interesting trades like that that happen also on that side of the world. So if you talk to your broker, there might be an opportunity. They might know about it. They might be able to trade those kind of arbitrage for you as well too, because it's the same stock. So you can trade that also. Okay, so I think I answered all the questions there. We can round up on this because we're coming close to the end of our time. Let's go back to our slide on chart patterns. And the next the next pattern, which is the last one we'll be talking about today, is the cup and handle. Cup and handle. Cup and handle is an interesting chart pattern. It is also a reversal sign, and it tells you that the market is about to turn. Now, the one on your screen sort of almost looks like a head and shoulder, but it isn't a head and shoulder. And what is the difference? The difference is the neckline. The neckline of the shoulders are not aligned. Okay, you can see that one shoulder has a higher neckline than the other. That is what makes it a cup and a handle. Now, the handle must always be on the right hand side of the cup, not the other way. The handle must always be on the right hand side of the cup. And of course, as you can see, the handle is a triangle. It's a symmetrical triangle. So you can see that clear information about a cup and a handle. The cup is deeper than the handle. The handle is a symmetrical triangle, and it has a lower shoulder than the left hand side of the cup. So that was what makes it a cup and a handle. And it's also a very strong indicator that price is about to switch to a different direction. So you can have a cup and handle that is facing up or a cup and handle that is facing down, but the handle stays the same. The handle typically is on the right hand side of the cup. Okay, not on the left hand side, on the right hand side of the cup. Um, and pretty much like your head and shoulder, you're also trading a breakout point. You're also trading a breakout point. So you trade a breakout for this cup and handle also. Um, you trade a breakout point for this cup and handle. You can see the breakout point just at the top of the triangle there. If you look at where this breaks out, and you can see that there's an extended breakout. This was a chart for an index, S&P 500 index, and one interesting thing I could share with you guys is if you look at most markets around the world, coronavirus has had a significant impact on them to the point where a lot of them have lost value and the indexes have gone down. Now, as an investor in this market, you know that once the economies start to boom and people start to recover, markets start to recover, governments have pumped a lot of liquidity into markets. And as a result of the liquidity that they've pumped into markets, all that funds is there to try and sustain the economy through this difficult time. But once the economy starts to sustain, starts to grow back, there will be a lot of markets where there's now too much liquidity, or government still needs to keep on pumping liquidity to sustain the market throughout the year, just to ensure that the economy continues to grow. So markets will tend to rise after pandemics like this, and a simple way to just ride on that wave of recovery in markets is to buy an index fund. To buy an index fund, that's a mutual fund that is traded on the exchange that tracks the performance of that exchange. In other words, it owns a single share of each share that is listed on that exchange, so that as the exchange moves up, that index fund also moves up. And if you've watched some of my past videos when I was talking about how to buy the dip, if you go back to watch that video on how to buy the dip, you'll see where I talked about index funds extensively. So you can watch that video. This is also a point to mention that if you haven't subscribed to this channel, please make sure you subscribe. There'll be a lot of helpful videos here. In the comment section, you can ask a lot of questions. I always answer the questions in the comment section, so feel free to ask questions there. I'm also constantly looking at the chat here to see if there is more questions. Okay, I see a question by Kelvin. Kelvin says, when did this session start? Because I'm just stumbling on it. Can I get more info, please? We started at 2 o'clock Nigerian time, but this is starting to approach probably 4 o'clock Nigerian time. While it's just about almost 9 o'clock Canadian time here. So we're almost rounding up already. But there's a link at the top of this chat window to the materials. So if you can please scroll up, you'll see the link to the materials, and you can download the materials that you are currently looking at on your screen. Okay, so the cup and handle is an interesting chart format, and the two of them are, the cup and handle and the head and shoulders are pretty much the strongest ones that I tend to look at, but most times you also see triple bottoms or double bottoms or tops in the market that tell you a lot more about prices, and you can use that to trade. So a good trader would typically combine fundamental and technical analysis. And so you see your price charts, you have your valuation of what you want to buy or where you think prices should be, which is the fundamental analysis, and then you use the technical analysis and the patterns that you're seeing in the market to decide, okay, I think this is the point where I should enter and buy, or I should wait, or I can sell at this point. Okay, so just a quick recap of all that we've talked about today. We talked about what technical analysis is. We said technical analysis is the use of pricing, your price charts, your historical pricing data, and market indicators to understand market direction, market movements, identify trends in the market, and then generate trading signals for entry and exit from an investment position. We talked about the principles behind it. We said, look, history always repeats itself because human beings are creatures of habit, and so we react to prices of asset classes in very repeated ways. Because of our mindsets, because of our attitudes, we have defined reactions to prices, and as a result, it creates trends in the market that technical analysts can use to identify an entry point or an exit point. We also said, look, market trades in trends, and those trends are identifiable. We said that, look, you need to combine your fundamental analysis with your technical analysis. We also talked about different types of charts: the line chart, the point and figure chart, the bar chart, and the candlestick chart. And then we talked about supports and resistance, and we said those are psychological price points, especially for buyers when they tend not to want to buy above a price point, and that is what becomes the resistance in the market. And for sellers, when they don't want to sell below a particular price point, and that becomes the support in the market. So those are resistance and supports. And we said, as a result of the resistance and supports in the market, we have all kinds of chart patterns that form that you can use to identify where the market is headed. We talked about triangles. We talked about bottoms and tops. First of all, bottoms, which are basically when price bounces off either a resistance as a top or off a support as a bottom. And we said it could be double bottoms, they could be triple bottoms. We talked about triangles. Triangles could be symmetrical when the market is just heading sideways. and you typically want to wait for a breakout, or we talk about ascending triangles when the market is generally heading upward and you're still trading a breakout, or market descending triangles when the market is typically heading downward and you're still also waiting for a breakout. We talked about wedges, we talked about flags, we talked about heads and shoulders, and then with head and shoulders, and then we talked about the cup and the handle. That is the introduction to technical analysis, and that is where we'll end it for today. In the next class, which I hope we can hold very soon, we'll talk about the indicators, which you will see on this slide, but I'll be adding more slides to this, where you would see indicators. We'll talk about different trading strategies, and then we'll talk about some principles for trading in markets generally, how to protect yourself when you're trading in markets so that you don't just take a loss that you shouldn't take, and how to secure your trades as well when you're trading on different trading platforms, either buying equities or buying derivatives and so on. Thank you very much for joining the class. I hope that you have found this useful. Someone is asking a quick question here that which strategy do you personally find more profitable, scalping, swing trading, or day trading? Okay, so I alternate between strategies depending on the market I'm trading, depending on the assets or the target price I'm trying to get. I have trades in the market that are as old as January that are still in the market, because when it comes to those particular positions, I'm investing, so I'm waiting for a long trend. There are trends that I notice are usually when I'm trading something like Tesla, it's a short-term trend. I'm just jumping in and jumping out within a couple of days. It depends on what I'm trading. If I'm trading something like gold, you want to hold it for a long period of time. Gold is a long-term trend, upward direction asset. But if you're trading something like crude oil, short trends, crude oil tends to change direction within a short period of time. So if you trade crude oil, for instance, like right now, I'm pretty positive that crude oil will still trade at a higher price later this year. The question is just when should you buy? So, and I don't think that time is yet. So, most of my contacts that we're always talking about trades, I'm currently encouraging them. Look, just hold your fire, hold your trigger. Don't buy yet. Just hold on. Crude oil is still going to trade at a higher price. So, but the trading signal is not very clear yet. So there's still a lot of crude oil that is in storage that needs to come out of storage and sell before we start to see a significant increase in prices. So that's that. Please confirm if fractional investment in equities is available on Webull. No, sir, there is no fractional. Fractional is when you don't have to buy the full equity. You can just buy a percentage of it, which is what you can get on some of the Nigerian platforms that I've mentioned in previous videos, which if you go back and check my YouTube page, you can find them. But on Webull, no, you cannot buy fractional shares. Again, good time to mention that this particular class was sponsored by Eagle Global Markets. Eagle Global Markets is a global trading platform based in Nigeria, Ikoyi, Lagos, that allows you to buy forex, equities, commodities, and cryptocurrencies on their platform. And you should check them out. I will post a link on this chat window in the next few minutes that will allow you to set up a trading account for yourself. You can set up a demo trading account and you can test out your trading strategies. You can look more at these charts and try to get more understanding about technical analysis. You can look at different asset classes. You don't have to trade immediately. You can use this to understand technical analysis a lot more. You can set it up at no cost to you. And of course, like I said, the first 10 people to register, your accounts will be credited with 10,000 Naira so that you can use that to start trading right away. On Eagle Global Market, fractional shares are available, so you can buy small amounts of even though Tesla is $700 in the US market, you can actually spend just 2,000 Naira and buy Tesla because you're buying just a portion of Tesla shares. So it's called fractional shares, which is available on Eagle Global Markets. Someone is saying, so crude oil is a no buy at the moment. That is what I would suggest, yes. I don't think crude oil is a buy at the moment. I'm always chatting with a couple of traders. This is my view, really. And again, this is not a recommendation. I try to avoid giving recommendations. The fact is, crude oil is currently trading at that price where it is trading because don't forget, all the time that crude oil prices were falling, people were still pumping at the same amount. The world pumps about 100 million barrels of crude oil per day. All that crude oil was still being pumped. And meanwhile, the larger consumers of crude oil, China, India, America, their economies were shut down, were literally shutting down, and so their demand had dropped consistently. And this is also Q2. Q2 is when traditionally all refiners tend to go into refinery maintenance. So they shut down their refineries, they do all their cleaning, clean all their distillation units, and catalyzers and chemical filtering units and all that. And so they shut down their operations and they only use crude oil from storage. So demand has fallen drastically. And where are the major refining hubs in the world? You have the Asian hub and then you have the European hub. Now, the Asian hub has fallen drastically because of China, which was the largest consumer in that region. And then the European hub, which is where there has been the largest amount of competition. So, when the battle between Saudi Arabia and Russia started, Russia typically sells the bulk of its oil to the European hub. Saudi Arabia, that sells mostly to Asia, decided that, look, since Russia wants to be petty, we're also going to show them how petty we can get. Saudi Arabia pumped more volumes, hired ships, about 25 of them, very large crude carriers, and sent all of them into the European market, which is also where Nigeria sells the bulk of its crude oil. And that is why, as at all of last week, even though crude oil prices were as high as $28, $30 at some point, guess how much Nigeria's crude oil was selling? Nigeria's crude oil was selling as low as $13 per barrel. So, just slightly less expensive than a packet of sugar, like I typically buy here, which for like $15 or so, you could buy a barrel of crude oil, of Nigerian crude oil, Bonny Light. As we speak currently, Nigerian crude oil is still available in the market for about $13. So if you want to buy crude oil, for Nigerian crude oil, you can buy at $13. But so, and the reason is because all that crude oil is on the high sea, in vessels. Nobody is buying, so they haven't been sold yet. Nigeria itself still has well over 60 cargoes of crude oil that is not sold, close to about 60 million barrels that is not sold, and we're still pumping our oil into the market. So it's going to take a while for all that to clear out. We need to clear out. So that's why when OPEC decided they wanted to cut 20 million barrels from the market, the idea is that over time, that 20 million cut would help to clear out what is in storage and then create the scarcity that will push up prices back. And I think that would take a couple of months before that would happen. So yes, it's crude oil a no buy at the moment. I would say you would see some short-term ups and downs between prices, but no, it's a no buy at the moment. Ladies and gentlemen, that brings us to the end of this class. I will still edit the links on this video. It will be available on the page. I will put a list of the books, some books which I recommend. Those are the books I read, especially when I was moving to this particular side of the world to start, this investment management, psychology of trading, the day trader, and then of course the investment Bible by Benjamin Graham, value investing. We'll talk about. I'll put a list of all that in the description of this video. So if you want to look for books that you can read to learn more about trading, those books will help you significantly. I'll also put a link to Eagle Global Market where you can set up your trading station. You can set up your trading account. You can demo trade. Demo trade means you're just using paper money to trade live markets. So you're trading live markets, but you're trading with paper money. So it's not real money. But you can use that to test out your strategies, understand trading a lot better, and so on. And then I wish you all the best. So thank you very much for joining the class. The video will be available in a couple of minutes on the website. Thank you and God bless.